Hi, and welcome to Futures Discovery at John Lothian News. I'm your host, Cortez Draper. On this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're delving into a fundamental aspect of futures trading that influences prices and creates opportunities: the cost of carry. Let's strip away the complexities and uncover the basics of how this concept shapes the dynamic of futures pricing. At its core, cost of carry outlines the expenses tied to retaining an asset over a period, establishing a relationship between futures prices and spot prices. This dynamic manifests in two main market scenarios: Contango and backwardation. In the Contango market, futures prices surpass spot prices due to significant carrying costs. These costs can include fluctuating interest rates, dividends or income from the asset, and storage costs, especially relevant for commodities. On the flip side, we have backwardation, where futures prices fall below spot prices, often signaling asset scarcity or high spot market demand. Various factors influence cost of carry, including changes in interest rates, dividends, storage costs, and the convenience yield. The convenience yield is the advantage derived from holding the actual commodity rather than its futures contract. Understanding these factors is crucial for informed trading decisions. Moreover, any misalignment between futures prices and cost of carry can present lucrative arbitrage opportunities. Astute traders can exploit the price differential between the futures and spot market, capitalizing on market inefficiencies. As we edge closer to a contract's expiration, the futures price aligns more closely with the asset spot price, and the impact of cost of carry lessens. However, market volatility can sway these costs, emphasizing the importance of understanding this dynamic for informed futures trading. And there you have it, the basics of cost of carry. Now remember, this is just scratching the surface. To gain a deeper insight, let's talk to Pat Hillgas, with over 20 years of experience as an independent trader who brings a wealth of knowledge to the futures industry. And stay tuned to the end of the episode, where we'll add a quantitative segment to look at the numbers and charts real professionals use to make informed decisions in the futures market. Pat brings a rich background from his time at Contango Grain Company to his current position with over 20 years of trading experience. Pat has transitioned from serving as a floor trader to becoming an independent retail trader. Pat, thank you for joining us today.
Thank you. I have to correct you once. I've had over 40 years of experience, not 20. So
yes,
I've been around the block twice.
Nice. Just adding to the seasonality for all the viewers at home. That's doubling it down right there. That's great. Can you provide a brief explanation of what the term cost of carry means in the context of futures trading?
Futures are based on the delivery process, meaning if I buy a contract and I do not get out of that contract some point during the delivery process. So if I buy a January contract, somewhere between January 1st and the business day preceding January 15th, I will take delivery of that. It's not like Amazon. It'll mean that my clearing firm will get a notice from the Board of Trade saying your client has taken delivery of wheat. Well, it wouldn't be wheat in January, but say soybeans in January. On day one, they will announce what the deliveries are. On day two, I will find out what I took delivery of and how much I have to pay. And on day three, I have to come up with the funds for that. There are different reasons people would come up for the funds and take delivery. A commercial firm would take delivery if they believe delivery was the cheapest source of cash, meaning they can buy grain through the delivery process cheaper than they can buy grain in the cash markets. Okay? Vice versa, a commercial firm would deliver grain if the price and the earnings through storage that they will get is better than they can get by selling it in the cash markets. I'm an individual trader. I don't have anywhere near the money Cargill does or any firm like that. So why would I get involved in it? Well, I would get involved in it because you can calculate what it costs for a period of time to take delivery and carry it from period A to period B. So for example, if I take delivery on January 15th, and I'm going to carry it till March 1st, I would get my calculator out, determine how many days that is. It's probably something like 46 or 47 days. And I would figure out what the storage for that is. And that storage would tell me how much it's going to cost me to carry that grain from January 15th to March 1st. If the spread is wider than that, So if it costs me 12 cents to carry the grain and the spread is 15 cents, then that means that I can earn 3 cents in implied interest by taking delivery of that grain. Now, is 3 cents good? Well, what is 3 cents? If I have, let's just make the numbers easy. If I have $500,000 worth of grain, which isn't a lot of grain, because like in soybeans, each contract is about $60,000. So that's roughly 8 contracts. It's not like you're taking delivery of 1,000 contracts. You're taking delivery of 8 contracts. Okay. If I make 3 cents a bushel on 8 contracts, that's $1,200 in interest. It's 150 times 8, it's $1,200 in interest. Okay. If I could make $2,000 in interest, putting that money in the bank or in a T-bill or in something else during that window, it's not a good opportunity for me. So I compare what I can earn in the cost of carry to what I can earn in alternative investments to determine whether I really want to allocate capital to that. Now, for a lot of people don't have $500,000 sitting around, so they would have to borrow money from their clearing firm or some other source, a bank or so forth. Well, if their implied earnings are 5% and they're borrowing it at 9%, it's not a winning proposition. Doesn't mean they won't do it. Now you can ask, why would you try to earn 5% when it costs you 9%? Because you're losing 4% theoretically. Well, the reason you would do that is sometimes when you take delivery, all of a sudden the cash markets change and somebody needs to buy those receipts back from you. And if they buy those receipts back from you at substantially better than what you would get by carrying it to the next delivery cycle, then you could make money. And sometimes that happens. And there are people out there, a lot of people who are taking delivery. They're taking delivery of a lot of contracts, not 8, but like 300 or 400 or whatever the limits are. So they would take delivery and they would hope that somebody would come and buy those from them and they would make some money on that. So that's one reason to take delivery, even when it looks like it's not a good opportunity.
Can you talk about maybe the 2 scenarios that we see in the markets a lot of contango and backwardization? Let's
say hypothetically we get to a situation where soybeans, when they have a end of the year carryout, let's say 200 million bushels, and we go down, all of a sudden there's not a lot of carry out there. Okay, you're talking about times 2 weeks worth of usage. And so the market needs to find where the beans are before the harvest comes in. Because one of the things you learn in this business is that if you're a crusher or if you're a wheat miller and your job is to buy that product, well, you're going to pay a price to keep your plant open because the plant makes a lot of money and you need to supply that. So in periods of tightness where you have inverted spreads, inverted means, for example, the July soybeans, it might cost, 12 cents a month roughly to carry it. So the July-November carrying charge might be in the 50 to 60 cent range, depending on interest rates and things such as that. But there might be times where July, instead of being 50 cents discount, but the market needs every bean that's available in the country. I've seen it $1, $2, $3 over, meaning July is a premium. So what does that tell the market? The market's always telling every participant something. So when July is $3 more than November is, that's telling the supplier, the farmer, or the grain elevator, look, I'm going to pay you $12 for beans today. I'm going to pay you $9 for beans in November. Makes no sense to carry those beans for 3 months. You're going to lose a lot of money. So that's telling the farmer, you really shouldn't carry those beans. So a grain buyer wants, in an inverted market, wants to buy as much as needed and as little as possible because it's a lot cheaper in the future. Whereas the flip side of that is when you're in a big carrying charge market, you can buy the spot month, hedge it in the deferred month, and earn that carrying charge. And you're willing to finance your inventories because the market's saying there's too much supply on the front end of the market, and we have to pay people. We have to pay elevators and pay farmers not to sell their grain now. So how do we pay them? We pay them more for July than we pay them today. And a farmer or a facility has to say, okay, I can make 50 cents carrying my grain. What does it cost me? How much does it cost me to store that grain? How much does it cost me to finance storing that grain? How much does it cost me in terms of risk that the grain will go bad? There's a lot of things. So it's not, you just don't always earn that 50 cents because there are costs associated with that 50 cents.
How does someone maybe start looking at those potential costs when they're looking at opportunities for them to carry? What are some more of those costs and perspectives into how to analyze those costs when looking at a delivery?
In March, I take delivery. So now my position is I'm long cash corn and short May corn futures. So what's the big deal? I'm long one and short the other. The big deal is I'm short with the Board of Trade. So if corn rallies $1, every night I have to pay a margin call. Every time corn rallies a bushel, that's $5,000. Okay, so I've got to finance that margin call. Okay, I've got to put money up with the clearing corporation literally every day. When they say call and they say, okay, you have $20,000 in your account, you have a $50,000 margin call. By the end of that day, I have to come up with $30,000. Okay, so as the futures price goes up, I have to come up with more money. So even though I thought, okay, I bought corn's $4, that's $20,000 a contract. I bought 8 contracts, $160,000. Now I got to come up with a lot more money. The delivery process is it's not that it's not well known. It's just for a lot of people, it's not the game they want to play. They don't want to come up with the cash. They want to trade something that's active. For a lot of people, they start the day with no position. They end the day with no position. They don't want something that's illiquid that would be hard to get at. They want a tight market that they can get out of. A lot of times, especially in inverted markets, the markets can move pretty violently as you get, especially if you're in, when you have a big inverse, you can have big moves that a lot of people aren't comfortable with, and it's just not their game. Plus, clearing firms guarantee activities. Okay, that's how this thing works. Clearing firms put up money, and if I buy something and I'm just an individual like the thousands of other people that are trading, and I just run out of money, my clearing firm has to come up with that money, because when they ask me for money, when the board trade asks me for money, it's the clearing firm that has to put up that money, their exposure. So a lot of these firms really don't want people trading the delivery process. They want people just trading back and forth and back and forth. They don't really want, so it depends on your firm, depends on your firm's risk tolerance and things like that. And frankly, it's true for even the big firms. I mean, a lot of these firms have cash lines of credit, and the banks they're borrowing money from say, okay, you're getting close to being extended on this thing. Maybe you need to get rid of some of your hedges and figure out a way to where you don't have these gigantic calls, because it's a risk. It's certainly been a risk at times with South American firms who have been hedged in dynamic markets, and all of a sudden the futures explode up and the South American prices don't. So the hedge doesn't work as well because people just can't come up with the margin calls. So those are things you have to think about, what your risks are. And when you're somebody like myself, or even big firms, you have to think, okay, what happens if the world blows up? I mean, you try to think what happens in the worst of situations. And if you think your risk is 20 cents, can I afford $2? What happens when things really go south? And the goal is to be here tomorrow. I mean, somebody always said, don't trade big enough, you can't trade tomorrow.
Can you explain a little bit of what full carry means in the terms of cost of carry?
Wheat has what's called a variable storage rate right now. And the Board of Trade puts out a calculator every day during their window. And that window calculates what they consider full carry, which is, storage plus interest. And if the spread is trading at more than 80% of the cost of carry, then the VSR expands. And if the spread is trading less than 50%, the VSR declines until it gets down to the minimum VSR level. What is some advice that you would offer some, aspiring individuals looking to get into the trading business or into the industry at all? If you're a young person, you have to find a situation where you have a certain amount of capital, because if you have too little, you're going to get blown out, because you're going to lose some money. And if you get blown out, well, the game's over. So you have to be somewhat well capitalized, or working for a firm that enables you to be somewhat well capitalized. You have to trade within your parameters. If you're a 1-lot trader, you're a 1-lot trader. And if you're a 100-lot trader, you're a 100-lot trader. He or she has to really understand, okay, I worked 10 days and I made money 5 and I lost money 5. How depressed am I? It's no fun losing money. That's one of the things you learn very quickly in this business. It's no fun losing money. So you have to have a mindset that's okay with that. And that isn't really easy, to be honest with you. Most people go to work, when they leave work, they have a little more money than they came to work with. And so, I mean, you gotta be okay. I mean, there's reasons some people in this do well and some people do really well. And, statistically, a lot of people don't do really well. So you have to be okay with what happens if you don't do really well.
The ability to stomach, the market and the industry and how it goes and swings is, I think, good advice for anybody looking to get into the markets or get into the futures industry at all. So I appreciate that. And Pat, we appreciate your time and insights into the intricate world of cost of carry in the futures industry. Your experience and expertise provide valuable perspective as we navigate the complexities of the financial market. Thank you for being part of Future Discovery. Thank you, Pat.
Thank you. You guys have a great day.
Congratulations. If you made it this far in the episode, it probably means you have a good understanding of the fundamentals of cost of carry. But to gain a deeper insight into cost of carry, let's take a look at a couple quantitative tools that traders use to make decisions surrounding the space. We'll look at some market data and some forward curves. To start, let's look at this dynamic of the cost of carry with futures contracts on the CQG platform. Here, we'll analyze futures contracts with the same underlying asset, corn, but different expiration dates to see how these trading prices differ. This is the CQG trading platform, CQG1. You'll have a quote spreadsheet right here on the far left, and this is what we'll focus on today. If you want to make a new list, you can go up here to the quote spreadsheet, click the drop down, put new list. Already have a fresh list ready to go, so we'll just do add symbols, okay? So today we're looking at corn. The ticker symbol for corn is C. Corn, C, has some more drop downs. Now we're looking at corn with different expiration dates. And so we'll see, it starts off the same for all of them. FUSC, futures US corn, C is the symbol, but then the letter preceding your ticker symbol, corn today, C, is a symbol for the month. H representing March, and then some numbers representing the expiration year, 24. Corn, the underlying asset, with the expiration in March, which is H, in 2024, which is represented by 24. We have K now representing May, an expiration in May. We see an N for July, expiration in July 2024. Then we see a U for September, a Z for December, and then we even have the start of the next year. But understand that expirations go farther than this in the future. We'll see a forward curve later with years and years into the future. But for futures traders, spread trading, the most liquid curves, the most active curves are those 1 to 2 years in the future because they're the closest to expiration. So let's add these into the quotes we'll be looking at. CH24 for March, CK for May, CN for July, CU for September, CZ for December, all in 2024. And then we'll even look at the start of next year, CH, March 2025, CH25. And so we'll add that to our list. We'll see OK here. We can see that we have all our contracts laid out for us, and then we'll mark them down what the price is. So for CH24, our March 2024 contract, currently trading at 443. For CK24, May corn is currently trading at $453. CN24 for corn trading in July is currently trading at $463. We'll round up. For CU24, September corn currently trading at $469. For CZ24, this is December corn, currently trading at $477. CH25, the March corn for 2025, currently trading at $487. We can see that price for corn is more expensive for markets with expirations further into the future. So this implies a growing cost of carry, and also shows that the price of corn should go up in the future, but it's already incorporated in the change of expiration. So as you start to roll these contracts, we'll talk about rolling, this price change is already incorporated with future contracts with expirations farther into the future. And so that's what we see here. Now that we've had a chance to look at some market data from CQG on corn and really analyze that how different expirations on the same underlying asset can have different prices. So we have all our contracts down here. So these are futures contracts for corn up here, that's what it says. By expiration, we have CH, so March, March, May, July, September, December, and then March 2025 corn. So those are all our expirations from CH24 to CH25, and then all our prices on the left-hand side on our y-axis of this graph, okay? And so let's look at this from here. So we said CH24, our March expiration corn, is currently trading at $444. So that's what we'll do. We'll mark the current price of each of these futures contracts. And remember, I said this is not a time series graph. These are what these contracts are trading for right now today. Let's also draw in that these are expirations, right? Each one of these contracts have an expiration, okay? So we'll say that this March 2024 CH24 contract will expire before the May contract, the CK24. At this point, this first dotted line, that's the expiration of the CH24. This contract will no longer be trading. It will have expired. And so if you want to interact into the market, you will now have to go to the May CK24 contract in order to still stay in this corn market, okay? And so we'll do that for all of these. Each contract will expire at the preceding dotted line, okay? If this March 2024 contract has no change in price, so this hypothetical movement of no change in price all the way up until May, there will be a jump in price in the market. There will be a jump in price in the market. It'll go from this price to this price in the market, just a huge swing up in the market, okay? And we can say this for all of them, right? If I stayed in the market, and let's say I was inherently bullish on the market, or I thought the market was going to go up, I wanted to still participate in the corn market, right? At the end of expiration, I would have to sell here at the end of expiration and buy here at 455 to continue to participate in the market. And so what you're seeing here is a rolling of contracts. And so this contract, in order to roll, this March contract, in order to roll into the May contract, you would have to sell low and buy high. And as you can see, that would bite into your profits, which we'll explain more in later episodes on Contango. And a forward curve would draw this in a linear manner like so, but that's not necessarily how it would be if you're trading in this market. You might have to sell low and buy high, and that's what a contango market's really representing, at least from a trading or a firm perspective. Let's do a real quickly look at this from the opposite standpoint. This is not what the market data showed or the forward curve, but was used as hypothetically. And let's just say if this was reversed, price doesn't change over the duration of the contract until expiration, okay? So let's look at this dynamic and how it differs from here. Here, we said the current trading price is 487. It doesn't change until expiration for the March contract, but if we want to get at the May contract, bam, it's at 477. And so as we rolled into this new contract, what we would be doing here is selling high and buying low, right? We sell at 487, buy at 477, we're looking at a $10 profit. This market will look like this, linearly down, right? As futures prices being lower than the spot price. And this would be backwardation. And so Contango, future prices being higher than the spot price, backwardation, futures prices being lower than a spot price that we're working in right now. It's important to see this because now we can also see the dynamics of rolling these contracts, which is such an important part of the futures industry. And we can see how the type of implications they can have when interacting with these markets.
To get a better understanding of the cost of carry dynamic, let's look at the spread calculations from ADM. Let's also note that these prices will most likely be a little different from the ones we observed because this report was run on January 22nd, 2024, but the same principles still apply. If we start at the top with March 2024 corn, it is still trading at roughly 446. The spread from March 24 to May 24, the spread dates are the specific contract months that are being compared in the broad spread analysis. Current carry represents the actual price difference between the two contracts months in the market. It's the difference in price between the front month, which for us is March, and the back month, which is May. Current carry is what the traders are currently paying or receiving for the convenience of holding the commodity for 1 month to another. What we see is that the current carry is roughly 11 cents as an expense, representing the current cost of carry for corn. Full carry is the total cost of carrying the commodity from the front month to the back month. It includes various costs such as storage, interest, and other associated expenses. Full carry provides a benchmark or a reference point for evaluating the current carry. It helps traders assess whether the current spread is overvalued or undervalued based on the total cost of carrying the commodity. Full carry is roughly 22 cents for us. This shows that the total cost of carrying the commodity from the front month to the back month is more expensive than the current carry. The percentage of full carry is the percentage that represents the relationship between the current carry and the full carry. Traders use the percentage to gauge how the current spread compares to the total cost of carrying the commodity. A percentage below 100% represents the current spread is trading at a discount to the full carry, while a percentage above 100% indicates a premium. In this case, the percent of full carry is 48.6%. The spread is denoted in high and low values to represent the potential price movement between the two contract months. These high and low values typically indicate the expected range of price fluctuation for the broad spread. It's important to note that various factors can influence broad spread movements, including changes in supply and demand fundamentals, market sentiment, geopolitical events, and economic indicators. Traders use the broad spread calculations to analyze and identify potential trading opportunities and manage risk in the futures market. And so that's how you can assess a broad spread calculations or a broad spread report from left to right, looking at different expiration dates on the left-hand side of your corn, your future closes, right, what they're trading at for today. These are your spread months, the front to the back month, and you can look at your current, your full carry, and your percent to full carry, and then your spread at the end to see what your potential price fluctuations are. And that's the importance of using the spread report.